Good morning, everyone. We certainly appreciate you taking the time out of your schedule to focus on the trillion-dollar question, which is private equity the right move for you and your company? And this is put on by CRI Capital Advisors. We are a portfolio company of Carr, and Ingram, top 20 accounting firm here in the U.S., and we certainly appreciate and don't take for granted your time. We focus on advising family-owned and closely held companies to prepare, position, and sell for maximum value in the lower middle market, which we tend to define as $10 to $250 million.
Hello, everyone. This is Joel Sykes. I'm the partner and managing director here for the Capital Advisors team. Thank you for joining us today.
And I'm Paul Evans. I'm the vice president. I tend to focus on business growth and development. And if you ever have any questions, certainly feel free to contact me at paul@criadv.com.
We wanted to start this morning with just giving you a quick overview of our segment of the firm. As Paul mentioned, we're a portfolio company of a relatively large CPA firm, but our group focuses on mergers and acquisitions advisory. So we do help clients of the firm sell their companies when the time is right. And we've organized the firm in such a way that we're capable and qualified to do that. And what we've done is we've gone through the registration process with the Securities Exchange Commission. We are members of FINRA and the SIPC. So we are a registered investment bank with the Securities Exchange Commission. And in 2017, we had the honor of being named one of the top 100 M&A advisory firms in the country. And as the screen would indicate, we were recognized as being off the beaten path. So while there are quite a number of capable firms in New York, Chicago, Los Angeles, we are located in Montgomery, Alabama, and there are some firms off the beaten path.
And if you're listening from across the globe and ever need any interpretation of our Southern accent, certainly welcome to provide that as well. So about this webinar, what we'll be covering is the definition of private equity, what committed capital means, what $1 trillion are we actually talking about, what's the deal flow looking in the marketplace these days, the private equity option, would it really be a good fit for you? So we've got some indicators that will help you make that decision. We're going to cover market multiples. We have so many clients who call and want to know, what's the multiple in the market right now for my industry? We're going to give you an overview from the business services segment, but certainly we'll be able to tap into that for you and your company as well. We're going to talk about valuation from the technical aspect, but also from the market aspect. The 7 drivers of value. What are private equity groups actually looking for, and what needs to be in place to maximize the value, maximize the offers that you could receive? Another question that we get a lot is how long does it actually take, start to finish, to sell the business? And we're going to cover that in detail for you. And then a great case study from a private equity acquired client that I think will give you a great overview of exactly what can happen and what some of the possibilities are. And then at the very end, we will take any questions that you have. And you'll see there in your panel that there is a place for questions at any time along the webinar that you've got a question. Please go ahead and enter that. We'll cover those at the very end. So we're going to have some valuable time together. And again, we appreciate you taking that time. So what is private equity? We hear this term a lot, and sometimes we think that, wow, these are the takeover artists. They're the guys who come in and the barbarians at the gate trying to acquire and take over all these companies. But it's really an avenue of great possibility for a lot of business owners.
Yeah, and I think it's important to understand the money behind private equity. A lot of it is institutional money. So these are professional investment managers who are managing a pool of capital. Often that capital has been contributed by insurance companies, educational endowment funds, charities that hold a good amount of cash will often invest in this alternative asset class. And that gives each private equity group its own sort of personality. So some groups are going to be very focused on quarterly return or internal rate of return. Other groups may be focused on a 5 to 10 year horizon in which they hope to create value in the business as 3 to 4 to 5 times what they acquired the business for. So part of what our firm does is we look at each group individually in comparison to what our clients' needs are, and more than just does the private equity group have available capital, it's are they the right partner for our particular client in this particular situation.
That's a great overview, and I think that we've got to be thinking overall, and part of our role is to make sure that good fit is there, that we're looking for alliance. We're looking for someone who's going to be a great partner for your company, not simply providing capital or really pushing in an aggressive way that does not fit your corporate culture currently. But we want to really help you find the group that's going to come alongside you and really help and become an asset. Committed capital, and also known as commitments, it's a contractual agreement between an investor and a venture capital fund that obligates the investor to contribute money. The investor may pay all of the committed capital at one time, or it may make contributions over time.
So the reason we wanted to focus for just a moment on committed capital is because there is a difference. Most of the groups we deal with are committed capital funds, meaning that their investors are legally obligated to either they have provided the capital or they are legally obligated to provide the capital when it's called, so that when we're working with that group that is a committed capital fund, we can know they have access to the capital that they're telling us they have. This is in contrast to what's known as a fundless sponsor. And fundless sponsors are not bad guys. We deal with some of them. We know some of them. Many of them are great guys. But they are business people who are seeking acquisitions, and they don't have a committed pool of capital. They may have very strong relationships with other groups and other high net worth individuals and other investment groups that do have the necessary capital. We've closed deals with fundless sponsors, but we do want to be aware, are we dealing with a private equity group that is sitting on a treasure trove of capital that we'd like to tap into, or are we dealing with a business person who intends to go out and search for that capital? So when we talk about committed capital, the numbers get fairly large. So the reason we've entitled this webinar, The $1 Trillion Question, is because as of December 2018, private equity groups within the United States have approximately $1.14 trillion in what they would refer to as dry powder. That means they have committed capital, that legally obligated capital, in excess of $1 trillion. That's near an all-time high. The private equity industry has enjoyed some back-to-back record fundraising quarters. I think Q4 of last year was slightly down, but nobody really expects the robust fundraising within the private equity world to stop anytime soon. So one interesting facet about this $1 trillion is the private equity managers, they get paid when that capital is deployed. So they are becoming increasingly aggressive in searching for investments. They're not reckless. They are still very focused on making quality acquisitions. They're still responsible for the outcomes. They're responsible to their investors. So they're not reckless or foolish, but they are increasingly aggressive in searching for ideal targets in which they can deploy this capital.
And one of the things we're seeing is just an uptick overall in transactions. And when you're talking about they're not reckless at all, and in just a few minutes when we talk about the 7 drivers, they are really looking for solid businesses, good businesses that they're going to be able to invest in and be able to grow. But certainly we're in a very strong time of acquisition and movement in the marketplace.
We are. Volume has been good in both terms of the number of deals that are taking place each year and the valuations of those deals. And just one quick note on the slide we're looking at now, this would include the entire middle market. So our firm focuses on the lower middle market, that $10 to $250 million range. The middle market includes transactions into the multi-billion-dollar range. So some of the large numbers you see here include what are called mega deals, deals above $1 million. What you want to be careful of is you don't want to get you don't want to have someone present to you multiples and valuations and metrics that apply to a $1 or $2 billion deal when your company may be a 10 or 15 or $20 million deal. That is still an amazing and fantastic small company, but the metrics are just different. So someone may tell you, oh, well, you know, I saw where this deal traded at a multiple of 25 times earnings. Well, maybe so. That may have been a $10 billion deal, and you may have a really excellent $20 million business, but the valuation metrics are different. So on this slide, we can see that about 5,000 deals were conducted last year for a little bit more than $800 billion in total transactions. So activity is good. You can see the trough in 2009 when the recession was in full swing, but you can see a steady track back from that, and you can see the really strong activity in 2018. We expect a little less growth in activity in 2019 in terms of the number of deals, but valuations are holding strong. I think interest rates have settled out a bit. I think everyone kind of knows what interest rates are potentially going to look like over the next 12 to 24 months. So we expect another strong year from private equity in 2019.
When it comes to this capital deployment, people often want to know, well, what size do I need to be? What are they looking for? And typically, this is what we're hearing over and over again. If it's going to be a platform deal, if this is going to be an anchor business, an anchor company for this division of their portfolio, they're looking for a $3 to $10 million EBITDA value. If it's going to be an add-on, they already have their platform, they already have their anchor, they're looking at 1 million plus, and we've seen them actually dip a little bit lower than that. They're coming downstream a little bit right now in their add-on. So when you're looking at your company and your value, there's not the hard and fast rules that there were, say, 5 years ago, which we believe is an excellent opportunity for smaller businesses who are looking to take a portion of that cash off the table, bring some partners on, use another's capital in order to accelerate their growth and also contribute expertise in that arena as well. So when we're looking at the platform, 3 to 10, add-on, 1 million plus. Anything to add to that, Joel?
Just we have seen private equity groups come downstream a good bit lately, and so private equity is now an option for even smaller companies where formerly it was not. So, that goes back to that aggressive nature of private equity groups that need to get that capital deployed.
When it comes to the actual private equity option, it's really best for the owner who, number one, wants to secure a percentage of liquidity now. We will say that most private equity groups want to be in the control position, so 51% or greater. A lot of the deals we see are 70-30, 80-20. You keep 20% of the equity, 30% of the equity. So that's really the focus on that piece. Number two, that you've got 3 to 5 more good years. We feel like this is an area that people often are not concentrating on when it comes to the sale of their business. They're often thinking, well, when I get out, I'm going to get out. I'm going to retire. I'm going to sell it all. And I'm not ready yet because I've got so many good years left. And if you feel like you've got 3 to 5 or even more good years left in your industry, but would like a partner, that could really be a good call for you. Number three, desire to use another's capital for growth. When we get to the case study later on in this webinar, you're going to see exactly how that happens and what the impact could possibly be. Number four, you possess a vision for scale. So if you're looking at what you want this company to do, in fact, we were meeting with one of our clients yesterday, and the private equity group asked, what's your plan for the future? What are you wanting? And one of those who would be staying on said, I just want to see how far we can take this. How big can we become? So that vision for scale can be something that is a trigger for you. You're excited about a second bite of the apple. You're glad to take some money off the table right now, but you're also thinking, wow, what's my 20 or 30 or 40% going to be worth once a group comes in and multiplies the value of this business? And then you would also like the advice and the guidance of industry experts. Sometimes this looks like having an extra board to work through. It also gives you the right to call those investors, speak with them personally, rely on their expertise. If you're an add-on to one of their existing platforms, they've already got a lot of expertise in the industry. They know how to grow, and they will be aligning their knowledge and their resources to your company, and that could also be a strong possibility as well.
I would just add to that sometimes we hear our prospective clients say, well, I don't think I'm ready to sell. The next 2 years are going to be my best years ever. And I totally understand that. They see that their personal earnings are going to be higher than ever. The profitability of the company is going to be as good as it's ever been. But what happens after that? So the ideal time to sell is when you do have a good forward outlook. So you book those 2 years and you take that money off the table. If the years following that are not as good, even if they're only slightly down, if growth slows a bit, that can actually diminish the value of your company to an extent greater than the money you were able to take off the table during those good years. So it's always a difficult decision when to decide when to sell your company, but don't let the fact that, well, next year is going to be my best year ever. You need to stop and consider, does that make my company worth more? Should I really be considering this now? So just think about the timing as you think about that forward outlook.
That's some good insight on that. I think that the question we get probably more than any other outside of how long does it take to sell my company, people want to know what their company is worth, and they'll often ask, do we need to have a business valuation made? We're going to break this down into 2 areas. Number one is the technical business valuation, and then secondly, the market assessment and what the difference between those are.
So our group here at Capital Advisors, we do not provide technical business valuations. The CPA side of our firm does that for us when that's needed. And there are technical certifications and credentials that are involved with those valuation professionals. A technical valuation is a valuable tool when we think about things like a dissolution of marriage or a partnership dispute or a buy-sell agreement or an insurance policy or estate planning. This is a valuation that's going to have credibility to hold up essentially in court. If there's a dispute between partners or if there's an estate to be settled, a judge can look at a technical valuation and have confidence that it's a fair assessment of the technical valuation of that company. So it's very valuable in its right place. It is a service that our firm provides, and we refer clients who need that service to a different member of our team inside the firm to provide that technical valuation. What our group does, we refer to as a market assessment. So if you think, again, in the case of a partnership dispute, a court's going to want a document that they can look at and rely on. They don't want somebody like me to stand there and say, yeah, we could sell it for X amount of dollars. But when you get ready to sell your business, you do want that person to say, hey, here's what we could actually sell it for. So there can be a difference between the technical, mathematical, accounting valuation of your company versus what would actually sell for if we took it to market. So what our group does, we run a competitive process to maximize that value, of course. But we look at all the various industry factors. We do look at the income statement, of course. We do look at the balance sheet, of course. But there's so much more that goes into assessing the value of a company on the open market, and that is what we do for our clients.
And again, we focus in that $10 million to $250 million range. And at the end of the webinar today, I will give you some contact information if you would like to receive a complimentary market assessment. There are a lot of groups that charge some pretty sporty prices for this, but we like to supply this as a value add, certainly to the CRI clients, but also to new clients that are outside of our current arrangement. And so if you would like to have that, I'll give you that information at the close today. Now we're going to take a look at what some of the multiples are right now. This is for the business services sector, and each industry may have different levels of multiples, but you're going to see on the left-hand side, 10 to 25 million, 25 to 50, 50 to 100, and 100 to $250 million.
So just a quick run through of what you're looking at on this slide. So TEV is total enterprise value. That's the total value of the company. It doesn't take into account what debt you may have to pay off when you sell the company. That's what the company is worth in total. And so this slide in particular looks at platforms versus add-ons. Paul alluded to this earlier, where a platform would be a relatively large deal, probably, 5 million in EBITDA and up, perhaps even 10 million EBITDA and above, where an add-on would be a smaller company in that 1 to 5 million EBITDA range that a group would look at to acquire to add to its portfolio because they already have existing companies in the space. It breaks it down by individual seller versus a private equity group or a corporate seller. The above average column, they do look at certain financial statistics within the deals that take place, and this is the above average financial performance column here. So where, for example, the average individual family seller received a multiple of 5.8 times EBITDA for companies worth 10 to 25 million. Above average financial performers received approximately 6.3 times. So this is just one of the many research tools that we can bring to bear for our clients. We can search this database by NAICS code and several different factors to kind of narrow down on your specific industry classification what the valuation multiples are. I think one thing to take note of here is just the size premium. I think if we start with deals in the 10 to $25 million range, for example, in the add-on column, the average multiple was 6.1. In the 10 to $250 million range, the average multiple was 11 times. So as we spoke about earlier, just be careful that people don't throw out some really outsized multiples, because in this case, the size of your business does have a very direct impact on the multiple that you could expect to receive.
And certainly someone could be looking at these numbers, see that 11.0 and say, I was just researching your industry and saw deals being done for 11. And often that's going to plant an unrealistic seed that could get you excited and cause you to make a decision that may not be the best. What we try to do is to give the average ranges, to really focus in on your industry, to learn some about your business. If you're getting a call from somebody who doesn't know you, doesn't know your business, and doesn't know how much you're making, and they throw out a multiple that's pretty outrageous, then that should be certainly a caution sign. We're going to move now into the 7 drivers of company value. What are private equity groups looking for? What are they trying to measure? Certainly, they're going to try their best to get the best deal they can. What we want to do is to maximize the value of your company, and these 7 areas tend to lead to a maximum value. The first is financial performance. What shape are your books in? How good are they kept? How accurate are they? So Joel's going to talk to us a little bit about the difference between compiled, reviewed, audited financials, and a little bit about Q of E, quality of earnings.
Yep, and I'll qualify what I'm about to say with the fact that I'm not a CPA. Our CPA brothers and sisters in the firm actually do the reviewed and audited financial statements for clients of the firm. But where we come to play is that the quality of your financial statements can have a very direct bearing on the value of your company, and really the sellability and the successful outcome, the probability of a successful outcome in your company. So, of course, the basic level of financial statements would be just your internal books, whether you're using Peachtree or Sage or QuickBooks. That's just kind of the raw data. You can produce a profit and loss statement. You can produce a balance sheet. And for your own purposes as a business owner, that is completely fine. Private equity groups, because they are investing other people's money, they have a higher level of responsibility. So they're going to want to take a little closer look. It's not that they're untrusting. It's not that they're suspicious. But they've got to stand in front of their investment committee and promote this deal. They've got to respond to their investors about the return of this investment that they made on their investors' behalf. So they're going to want to dig a little deeper and just have some assurance that the numbers that were presented to them were accurate. So what we often see is companies that invest in reviewed financial statements or even audited financial statements, they can achieve a higher valuation and there's a higher probability of closing because there are fewer surprises for the buyer. So reviewed financial statements, a CPA will do just that. They will review your financial statements. They will test certain aspects of your figures to make sure they're accurate. And they will issue a statement saying, hey, we've done some testing. We've reviewed these financial statements, and to the best of our knowledge, they appear to fairly and accurately represent the financial condition of the company. That just gives a buyer one added level of assurance that, hey, we're looking at a manufacturing company, but a certified public accountant has looked at these financial statements, and he or she has said, we believe these are accurate and reflect appropriately the situation of the company that we're looking at. The next rung up would be the audited financial statements, and as you might imagine, that's even more extensive. CPA is going to do inventory counts. He or she's going to test receivables. They're going to track Invoices from the time you receive raw materials until the time the product is shipped out to a customer, until the time the money hits the bank. They're going to do extensive testing, and they're going to provide a fairly high degree of assurance that, hey, we have done a deep dive into this company's financial statements, and as far as we can tell, everything is fair and accurate in the way the company's presented. So whether it's reviewed or audited financial statements, it just gives the buyer a higher degree of confidence. Value is a function of risk, and in any bit of risk we can strip out of the process for the buyer, the higher that value is likely to be driven. On the flip side of this, we do sell companies that just use QuickBooks. It is possible. That's not a non-starter for us. What we find, though, is that there are often more surprises in those clients than with our reviewed or audited financial statement clients. It's not that anybody tried to hide anything. It's not that anybody was dishonest. Sometimes it's just a timing difference. There were invoices that came in after the end of the month that you didn't book in the appropriate month, and so we're going to have to adjust that. But more often, purchase price adjustments are more frequent with clients that do not go to the effort to have reviewed or audited financial statements. And it's just because in-house books sometimes are not as accurate. So you may receive an offer of $10 million for your business, and as private equity groups engage their own CPAs to investigate the financials of the company, they may discover an error, an honest mistake in the books, and that could change the value of the company significantly after we're well into the process.
One added note on this: all of these drivers are not created equal. So if there was an area that we would encourage you highly to begin with, it would be in this financial performance area, to make sure that the quality of your bookkeeping is completely above board and strong, because they are going to spend a lot of time in the sector. And to reiterate, it's very important to remember they are trying to negate risk. They want to make sure that the investment's going to be clean for them, that while they don't mind giving you maximum value now, they're still thinking about how much they're going to be making down the road, and it really begins with that clean set of financials. Secondly is the growth potential. They're going to look at it from two angles. Number one is the growth potential that you actually see in your industry and from your company, your past performance, but also your future performance. Now, there's a little bit of a temptation here. There's a temptation to look ahead 1, 2, 3, 5 years, and where you may have had some slow, steady growth, there is the temptation to try to maximize the growth outlook. And if you've not been doubling your business every year, if suddenly next year you're showing that you're going to double it, you've really got to explain that. But the other aspect is, and when we talk about earnout in a few minutes, they're more than willing to hold you to a number that you've got to reach in order to receive certain monies from the back end. The other thing about growth potential is that they are often experts within the industries. They understand what's trending right now. They understand what the future could look like and how difficult a multiple could be or may not be. And so they're looking at growth potential on what you believe the outlook is, but they're also looking at growth potential from their side and what they believe they're going to be able to bring to bear down the road.
Yeah, and just back to what we said earlier, the ideal time to consider selling your company may be when you have several years of positive growth out in front. And to Paul's point on sort of projecting that growth, investors are going to look for just reasonableness and credibility. Again, that doubling the company overnight, that doesn't always play well. But if you can say, hey, with added capital that's going to be brought in by a private equity investor, if we bought this equipment, if we penetrated these new markets, if we went down these different channels, then yeah, our growth could move from an average growth rate of 12% a year to 20% a year. But the key there is going to be a credibility and just sort of that reasonableness check.
The next area is customer concentration. What percentage does your largest customer represent, your second largest, et cetera? We will say that in general, they like to see 15% or less of your largest customer. Now, it doesn't mean that you can't go to market otherwise. We're working with a client right now that their largest customer is about 70%, but it's in a particular niche industry that is attractive, and it is with a group that is also attractive. So it doesn't mean that these are hard and fast rules, but we do know when they look at your customer concentration, if it's low, if it's spread out, and they're able to see also the consistency that over time, these same customers are coming back year after year, time after time. Now, in the upper region, like I just mentioned, the one with 70%, they've had this client for about 22 years. And so at least there's the longevity there. There's a contract in place, so that certainly can make a difference as well.
Yeah, I think the quality of customer is important as well. And private equity investors are, again, it's about risk. So how badly is the company damaged if one key client leaves, key customer leaves? So you may have a handful of customers that represent 50% of your business, but if the relationships have been there long term, if those are recognizable and stable companies, or if you provide such a unique service that those customers would be hard-pressed to find that product or service somewhere else, that can serve to offset concerns about customer concentration. But in general, private equity investors are going to look for a broad customer base to where the revenue is spread out over a large number of customers.
Right, because if you lose your main customer and they're out of business, basically, they're not for it. They're looking for that broad view that, okay, so we lose one of these even top customers, the impact is not going to put us out of business, and we certainly feel like we'll be able to make up that difference. Another area is cash flow. So, Joel, if you'll talk a little bit about accounts payable, accounts receivable, how that impacts value.
Sure. So again, we go back a little bit to the personality of the investor. Some groups are focused on sort of that quarterly return or that annual return on their investment. And how much capital does the investment group have to put into the company to keep it going? So there are things you can do within your company now to improve your cash flow cycle. So you may have been content for many years to allow your customers to pay you on 30-day terms or 45-day terms. Could you consider offering a discount to speed up that cash flow cycle? Could you, maybe you're one of those rare people that pays all their bills early. We have some clients that just, man, they get an invoice, a check is going out the next day at the latest. They just don't want to owe anybody anything, and so they keep their payables completely clear. That affects the cash flow cycle. That's going to make a private equity investor look at this and say, wow, it takes a lot of cash to run this business. Where if you change your AR policies and if you change your AP policies just a little bit, that could free up a lot of working capital in a private equity scenario. So there are things you can do now to start altering your cash flow situation that would be more attractive to a potential private equity investor.
You know, being able to stay on top of every facet I know can sound like it's almost impossible. How do I even keep up with what we've covered so far? You know, one of the things we like to do is to stay in regular contact with our clients, with those that we're walking alongside. You know, you may not be ready to sell right now. You may be a couple of years out or 3 or 4 years out. We certainly would love to be in regular contact so that we can continue to measure these drivers and make sure that they're on point as you move into a transition or a transaction. Another driver is recurring revenue, and that's going to take a lot of different forms. It can look different for different companies. Sometimes a company feels like, well, I'm just doing one-off sale, and so I don't really have any recurring nature revenue, but that could be repeat customers, it could be subscriptions, it could be contracts. There's a lot of different ways to define what recurring revenue is and how it can impact your value.
And I think, again, it goes back to risk. We're trying to provide forward visibility for the group that wants to purchase your company. So anything you can do to sort of solidify that customer relationship and that forward outlook is going to be important. Most of the companies we work with don't view themselves in a recurring revenue situation. They do view themselves as, well, hey, my clients call me, my customers call me when they need me. I've got salespeople on the street. We're doing our job, but this is not a recurring revenue model like a Jelly of the Month Club where it's just, or I'm getting older now, so the days when you used to order cassette tapes and they just sent you one every month, some people think that's the only way to create a recurring revenue model. But you can look at your customers over time and see their buying patterns and perhaps entice them into a different type of relationship to where they are committed to purchase a certain amount from you over a certain time period, maybe at better pricing, maybe at better payment terms. But think about the levers that you can pull to create some semblance of recurring revenue, even if you're not a true subscription-based business.
We have a client that we're working with right now that is not technically in the recurring revenue realm as far as what they're thinking, but they do have contracts that are being renewed every single year and have for a couple of decades. And so is that a subscription? No. Is that recurring revenue? Yes, because it is fairly predictable. It is low risk. The customers are long-term, and there is a contract in place. And that could possibly be another step for you as well, that you may be doing great businesses with your customers. It's always been done on a handshake, but a contract could be something to solidify that relationship and certainly prove to groups in the private equity realm that there is a predictable future for many of these customers. Market leadership and differentiation is another avenue that they tend to look at. Now, certainly they're going to bring in a lot of their industry connections and network, but they're also going to see how much of the market are you owning at this moment? How much more is available? And what makes you unique and different in the marketplace? We often ask that question, why are they coming to you over everybody else? And we really want a solid answer for that because you know your business. You're clear on what makes you unique and special. And this is certainly not the time to hold back and be less than, but instead say, this is what we do better than anybody else. It could be your customer service. It could be the quality of your product. Again, another one of our clients, they received a very large contract over a lot of years because their competitor was having a return rate that was almost catastrophic. It was really crazy. And so this particular customer came to them and said, could you produce something of similar quality? And they said, no, we can't. We can make it much better. We can do better quality. Nobody wants this similar quality. And so now they've had that contract for, I think, about the last 7 years because they knew the quality that they were going to bring to the table absolutely could not be matched. It was not simply a question of, we've got great quality. It was documented that their quality was better than the rest.
I think part of this is just as a business owner, understanding and being able to articulate your competitive advantage. We deal with small businesses. We deal with family-owned businesses. Now, some of them are worth $50 to $100 million, but when in the grander scheme of things, the deals that make the Wall Street Journal are many, many billions of dollars, we still deal with relatively small businesses. And you may feel like, well, I'm in a really crowded field. There's the one dominant player in this space, and then there's the second tier, and those guys are 5 to 10 times my size. But you can define and articulate what it is that you bring to the market, and maybe you're not the leader in the automotive industry, but maybe you're the leader in the automotive trim industry or some specific realm of automotive accessory. But think ahead of time before you get ready to sell your business. Think about what is it that I really do? What market do I really serve? And what market do I really lead? What makes me different? What am I providing my customers that no one else is providing? We're often surprised by how thinly private equity analysts slice various markets. And just to stick with the image we have on the screen here, we may think of the produce market or the fruit market. These guys have done so much research, they know, hey, we think peaches are going to be really hot for the next 5 years. And you may have a company that sells peaches. This is how narrowly they can get focused. So don't be discouraged if you feel like sort of a small fish in a really large pond. You may be doing something very special that could be very, very attractive. But think in advance, how do I identify that and how do I articulate that?
Last driver is owner dependence. How critical is it that you are actually working in the company day to day? So the private equity group is going to ask you, how long do you want to stay? But they're also going to want to know, how essential are you to operations? How strong is your management team? Are you able to leave for any amount of time, and the company itself does not skip a beat? Occasionally we'll run into an exception to the rule where somebody's really out of their company. We're just taking on a brand new client, and I was asking the owner, how dependent is the company on you? And he goes, well, I hadn't been in the door 6 months, so I guess it's doing pretty well. And it's doing great without him currently. And so that type of company that is set up on the assurance that the current management team is strong enough to handle operations if, again, risk, if anything happened to you personally.
So we work with a lot of entrepreneurs, whether it's a first, second, or third generation company. You've either built the company, maybe your parents or grandparents built it. It's often difficult to relinquish control. We see a lot of entrepreneurs wear an awful lot of hats. There's genuine value in surrounding yourself with a strong management team, so that if you have an illness, if you have a family emergency, if you just want to take some time off after so many years of driving this business, investors are going to want to know that the business can stand on its own legs without you there every day. You may still be the strategic driver, you may still be the leader, the motivator, but does every invoice require your signature? Does every bid require your signature? Are you the only one in your organization that can sign a check? These are difficult areas of control to let go of. I came up in a family business, so I understand. I remember the transition when my dad put me on the bank account. I was his CFO, and he still had to think about whether or not he wanted me signing checks. And I understand that. Even within a family, it can be difficult to relinquish control, even more so if you're going to bring in outside management to help you run it. But there is real value in surrounding yourself with a management team, not only who can help you drive profitability now, but who can give a private equity buyer assurance that the business survives long term, whether you exit it through a planned exit toward retirement or whether some event happens that makes you unavailable to help continue run the business.
Excellent. So those are the 7 drivers of company value. We're certainly open to having a call with you to walk through those in your company to see where you are, where there are some strengths and where there may be some opportunities for growth. The private equity structure element, sometimes this is the piece that will surprise an owner, because you think, well, I'm just going to get some money at close and I'm going to keep my operations going. But there is some structure to this type of transaction.
So here's a good place to contrast a private equity acquirer versus a strategic acquirer. So think of the big company in your industry that does pretty much exactly what you do or provides products and services very similar to what you do, and they're big. They're at least 10 times your size. They probably, number one, they have the money just to buy you outright, just to write the check for 100% of what they think your business is worth. They probably have the back office and the management to where they may need you for a year to help with the transition plan, but they can probably run the business without you. They're buying your business because of your geographic location or your manufacturing capacity or your customer or client list. It's not so much an investment for them as it is a strategic move. That's why they're called a strategic buyer. So they are often comfortable with paying 100% cash at closing and giving you a much shorter exit round. For private equity, it's a little bit different. They are very savvy in the industries in which they work, but they don't run companies day to day. They invest in companies. They deploy capital into companies. They support companies, but they're not the hands-on day-to-day managers of this company. So more often than not, what we see in private equity transactions is some combination of these elements you see on this slide. Normally, cash at closing is anywhere from the 60 to 90% range. We see an awful lot of 70-30, 80-20 deals where the existing owners, often the founder or the second generation owner, they retain a meaningful minority ownership position in the company. That's the equity roll. That's the rolling of equity. And there's some mathematics that go into that. A lot of private equity groups will use debt financing for a portion of the purchase price. They'll go to a bank and they'll borrow the money to write a check to you, the owner. You effectively get to buy back in at a post-leverage valuation. So the shares you essentially buy back are cheaper than what they bought the shares from you for. So you get a little bit of lift there. And when the time comes, we could walk you through the mathematics on how that works. But they want to know that you're involved going forward. Not only are you saying you'll stay for 3 to 5 years, but you've got a meaningful equity interest that's going to keep you bound to the company and incentivize you to help the company grow. Private equity groups from time to time do employ seller note or seller debt. That's usually subordinate to their senior lending, so they're going to borrow some money to write you that first check at closing. But hey, we also want you to have a $1 million note that's payable to you over 5 years at 8% interest. And that's the debt portion of the financing. And then the earnout piece would be contingent. That's a portion of your proceeds that are at risk. So a company may say, hey, we're going to give you $20 million for your business. We're going to pay you, $15 million at closing. We want you to roll $3 million in equity. $2 million of that purchase price, though, is going to be contingent upon the performance of the company in the coming years. Again, binding you to the company, incentivizing you to help the investment perform well.
A lot of great insight on those pieces, and that was certainly a high-level view, and we can go deeper with you personally to carve those out. How long does it take to sell the company? In general, and this is very general terms, 180 to 360 days. Anywhere from 6 months if there's a lot of work has been done ahead of time. Maybe there are some buyers already on the horizon. If it is going to be a complete process where we're doing the assessment, underwriting, marketing, diligence, and then finally the closing, we find that tends to be closer to 9 months to 12 months. So there is a good amount of time that goes into it. There's a lot of focus, a lot of resources that have to be deployed from our side. And also, there's going to be a lot of attention that you have to give the process as well. I don't know if you can see this really clearly on the screen, but on the left-hand side where the rocks go up very high, on the right-hand side they go up high, and it's lower in the middle, you can pretty much guarantee that your concentration levels on the process, that's what's going to be close. On the assessment and underwriting side, there's going to be a lot of attention that's needed. Diligence and closing, a lot of attention is needed as well. And then we're doing the marketing to reach out to buyers. We create the buyer list. We vet it. Everything is approved by you. We go out and do all the marketing for you. We put together all the materials for you. We host a data room for you so that we're trying to take as much off your plate as possible because you need to continue running your business, operating your business as you've been doing. And that way you're not skipping a beat, but instead we're coming alongside and doing a lot of the heavy lifting of this actual process of moving you from the very beginning stages all the way through a sale. Joel, anything to add to that piece?
Yeah, I would just add that, this is a data-driven process. It's a long process. There's a term out there called deal fatigue, even when we warn our clients about it. On day one, they think, no, man, I'm ready. I've got this. I'm pumped. I'm ready to go. And then, by month 6, when the data requests are heavy and the cycle's gotten long, it's like, wow, I'm really ready for this to be over. We see that on almost every transaction. I was told a while back by a buyer that, hey, buyers get deal fatigue too. We want to do this quickly and get it over with as well. So we don't deal with a lot of acquirers that just kind of drag their feet. Everybody knows that speed and efficiency is important, but it's a long and arduous process. But it's also one of the most, if not the most important business decision you're likely to make. Whether you're second, third generation, whether you're the initial founder of a business, in many cases, we're dealing with people for whom this company is their life's work, professionally speaking. So we do our best to navigate this process quickly and efficiently, but we do take the time to do it well because there's real money involved and there's real risk involved, and we take that very seriously for our clients.
Very quickly, we want to cover one of the case studies that is a private equity success story, and we've had several of those. We've got great relationships with some very credible private equity groups. And this is a deal that was done a few years ago. As you can see, there's a lot of information on that screen that you can't read. If you'd like a copy of the case study, I'm going to give you some contact information on the next screen. But for now, Joel, if you'll walk us through this case study.
Yep. So for every transaction we take to market, we generally consider two paths. We look for potential strategic acquirers, and we also try to pinpoint the ideal private equity acquirers as well. So in this particular situation, we did run sort of that dual process. Our client was Southern RV Supercenter, and we looked at other RV companies. This was a multi-location RV dealership. We looked at other companies that own large or multiple RV dealerships. We obviously also looked at private equity groups, and Main Street Capital Corporation emerged as the likely potential acquirer. They had an interest in the leisure space. They did not have an RV holding. They had some ATV and boat dealerships, but it was all sort of in that leisure space, and they seemed to kind of get the buyer mindset, the customer mindset, the customer mentality in that leisure space. So this was attractive to them. The company, Southern RV, was owned by two individuals. One was primarily a financial partner. The other was primarily an operating partner. These were longtime friends. To a certain extent, they ran the business together, but one partner was much more involved day to day than the other. So Main Street Capital Corporation came to the table. They made an offer. Of course, we negotiated for a while, but we got the offer within the range where it was acceptable to the buyers. The sellers, I'm sorry, our client. The financial partner was able to exit entirely. The operating partner was asked to stay for a time, and he actually retained about 40% of the company. Again, some mathematics involved, but he took a pretty nice check at closing and still personally retained 40% of the company. So, he was thrilled with what he received at this closing on this first transaction. They employed him to continue to run the company. He was a little wary. He was like, yeah, these guys are telling me they're going to be cooperative. They're telling me this is going to be easy. They're going to be in my business every day. And he said, literally, he called me one day. He said, hey, Joel, I haven't heard from these guys in a while. And I said, well, how's business? He said, well, we're crushing it. I mean, it's great. I said, well, that's why you haven't heard from them in a while. If there were problems, you would hear from them. But at the same time, he targeted other dealerships that he wanted to acquire. And he made the call to the private equity group and said, hey, there's a dealership in this area. We think it's a good move. Here's how much it's going to cost. They obviously supported him in the transaction. They provided the capital, did the diligence, but it was largely the original owner's decision on how to move that company forward, and they just supported him and funded him in that effort. They intended to hold the company for 5 to 7 or 8 years to grow it, but within, I believe, 3 to 4 years of acquiring it, a large publicly traded company came to them and said, hey, we need to be where you are geographically. And the operating partner who remained, his second check was actually as large or slightly larger than the money he took off the table at the first sale. So that is the ideal outcome. That is what we target when we think about the ideal private equity transaction for our clients.
That type of story and insight allows you to see what's possible, what could happen, and certainly we would love to have any discussion we could about that. A next step is that we would love to perform a market assessment for you, for your company. We will dive into the industry and what strengths are going on in that place right now, what the trends are, what the future outlook tends to be. We'll also do the deep research to find out what the average multiples are in your particular industry. We'll need just a little bit of data from you on that. And then if you'd like to walk through the 7 drivers to determine, where you are with each one and where you might be able to grow, we're certainly happy to do that. You can email assess@criadv.com or call 334-328-0988. That's my number, Paul Evans. So 334-328-0988. We've got just a couple of minutes left. I'm going to look and see if anybody turned in any questions while we were on the call today. And if you have any, certainly feel free to put those in this next probably minute or so. If not, you can email me at assess@criadv.com, and I will certainly get back with you. We've only got one question that came in. It says, if I know who the buyer will be, do I really need a firm like yours? Now, we do get that question a lot. Like, what's the advantage of working with an investment bank over simply doing it yourself? The question is, have you found a buyer or is it the buyer? We really center on bringing as many buyers to the table as possible so that we can have that competitive process that will hopefully push the valuation to a higher level. Secondly, who's going to complete the underwriting? Who's going to do the diligence? Who's going to put the marketing materials together? If there's a buyer that's coming in and giving you a number, you may say, I don't really need any of that. But if you're really going to go to market and try to maximize value, it allows us to be able to take all of that weight off your shoulders. And why? Because really you need to continue running your company, growing your company, be in the day-to-day operations. And we take all of that weight off of you. The other thing is, and I say this with a lot of humility, this is what we do. You run your business. It's what you do. This is our business. It's what we do every single day. And this may be your first and only transaction. Fortunately, we walked down the transaction road dozens and dozens of times. And so we understand the complications. We understand some of the roadblocks that are coming. We understand where to look for hidden value within a company and how to have those very tough discussions. Negotiation is not always easy. We don't mind that aspect at all. You're going to have times where you need to stand your ground and you need somebody to stand in that gap for you and with you. And that's exactly what we do. So selling a company is not easy. We don't tend to act like it's light or simple. It is our expertise and we love doing it. And certainly we'd love an opportunity to talk with you about your business and hopefully share some adventures together. Joel?
Yeah, no, I would agree with everything Paul just said. And, we often get personally attached to our clients. We're often dealing with a family or brothers or longtime friends. So there is a personal element to it, but we are able to look at the process objectively and to guide our clients through this very difficult process very, very carefully. So I think just having a second set of eyes and ears, having an advisor close at hand to help through some of the difficult parts of the transaction, we believe is most advantageous. And we are just, Paul used the word humble, we are just humbled and privileged to do what we do for our clients. And we feel the weight of what an important decision this is for our clients, and we do take that seriously.
Well, again, we thank you all for coming out today. We thank you for staying on the line for a full hour. We don't take that lightly. That's a lot of time and energy and focus. We hope that we've given you a great overview of private equity. If you would like to have a personal conversation, 334-328-0988 or email assess@criadb.com. We look forward to working and serving you together. Take care, everyone.